Welcome everybody tonight to our webinar on getting aggressive with tax savings. I'm Steve Olson with the Fourplex Investment Group, and we're really happy to have you. And before we really get going on this, I just want to tell you thanks for showing up. I hope you're doing okay. I hope you don't have the coronavirus, and I hope that things are going well with your job and your employment and such. And I've seen many of you who have registered. You're already clients of ours, or we've already been speaking to you for quite some time. And it's just good to have you on here and know that you're getting the emails and deciding to take your education to another level. And I really do sincerely wish you the best through what's been something that we all want to end soon. But I watched the press conference about 2 hours ago, and it looks like some of these states are going to be able to start the process of returning to, I don't know, is there a normal? But whatever, return to something. So we're happy to see that, certainly, and that makes a big difference and should perk things up a little bit, but we will see. So now that I've got that done, I just want to kind of give some context about our webinar here tonight. And this got started in an interesting way, because a couple of weeks ago, this guy was emailing me, telling me, hey, he's done some cost seg studies for some of our clients and energy credits and saying all this stuff. And I was pretty busy. And I paid attention a little bit to what he said, and he kept contacting me. And then eventually I was going, hey, you know what? That really is kind of cool. And it turned out that Mark Barbour, our guest tonight, had been doing a cost seg study for one of our clients at the Village at Brickyard in Idaho. And he was telling me some stuff. I do cost seg studies on my fourplexes that I buy through FIG. And he was telling me some stuff I was not aware of. And it was pretty cool. And we got to talking. And, most people that do this stuff, cost seg and accountants and taxes, will put you right to sleep. And Mark certainly did not do that with me. In fact, he gave me some great content. And I thought, you know what? If we're going to get investors to listen to this, taxes and such being, let's be honest, not quite as exciting as you want, but super important. Let's get them when they're all at home right now and they have nothing else going on. We know that they're stuck home and that they're going to be listening. So we got you. But I think you're going to be glad, because what we're going to talk about today, if you've invested in a FIG property before, is going to make a big difference for you. And even if you haven't, it's something that can be applied to a lot of different properties, and that Mark could certainly assist you on. So that's our plan here. Is you read the email copy that we sent out. There is tons of money getting printed and distributed and passed out. We're going to see jobs probably coming into the U.S. now. There's a lot of forces that are going to affect your real estate. And with all the money getting printed, inevitably, taxes and inflation at some point are going to be brought to bear. So we got to get aggressive. We got to get offensive on our tax strategies and save as much as we possibly can, because the bill is going to show up for all of this stuff. Whether you like it or not, it's showing up. And that's why we invited Mark. And he has more letters after his name than I know what to do with. He's got a ton of designations. He's a big expert in the field of cost segregation and construction, and what qualifies for tax breaks and what doesn't. And so he has prepared the content for you tonight, and actually has a couple of case studies on some FIG properties that he did studies on for a couple of our clients. One of them is actually me. One of them is one of my fourplexes. And he's going to walk through a little bit about depreciation for the W-2 earner. What does that mean? What's a real estate professional? You can really get into the weeds on that. We're not going to go totally deep, but he's going to give an explanation as to what that means and why you should all be chasing that to get there as soon as you possibly can. Cost segregation, what is it? Why does it matter for an investor? And then some of these cool things that are happening with year one bonus depreciation that came through the Trump tax law. And now this new CARES Act, right, that just got passed, I think a couple of weeks ago, and how that impacts you as an investor. And also some cool new energy credits that he found in some of our units that, because of the CARES Act, my understanding is you can go back in time a few years and claim more tax breaks retroactively. So that's what we're here to talk about. Mark, I'm going to turn the show over to you, and I'm going to just chime in. We're going to just kind of be like Mark's talking to me a little bit about this, and I may have some clarifying statements or questions along the way, but it's mostly going to be Mark's show. If you have a question that you want addressed towards the end of this. You can type it into the chat feature on Zoom, or depending on how we're doing here, we may unmute and give an opportunity to ask questions at the end as well. So Mark can take a couple of these. And not to worry, we're going to record this. We're going to give you contact information for Mark. So this isn't the end all be all of the discussion. You'll get all the clarification that you need. Mark, take it away.
Steve, thank you for the great introduction. I appreciate it. And I thank all the folks who are attending, and I really appreciate your time. I know it's some trying times, so I really appreciate it. And Fourplex Investment Group has been kind enough to have me. Just a little bit about specialty tax advisors. I've been in business for over 7 years, and prior to that, I worked for some top 100 CPA firms and other consulting firms. I started off in 1990 in KPMG's tax practice in their LA office. So I've been at it for a while. And in between then, I've also developed a lot of real estate. So I've learned a lot about construction. So this all sort of ties together the cost segregation, construction tax planning. There's also some nice credits we're going to talk about for the energy efficiency. Here's a little disclaimer, and I'll be sending out, they'll be available at deck in PDF format for you folks to check out. So sort of some of the reasons just to purchase a fourplex in general, instead of having, scattered houses all over the place, it's nice to have, convenience, they're all together, they're easy to manage. It's a good starter property. It's a great way to dip your toes in the water. The financing is easy, unlike, trying to finance 5 units and up. You've got the residential 1 to 4 financing, which is great. And you've got all the cash flow from 4 units. So, it's a good deal. So I've owned it just myself personally. I've had a lot of single family homes, and I really kind of regret not consolidating earlier into fourplexes and other types of, concentrated residential.
Then everyone, I asked Mark to just highlight this briefly because he brings a unique aspect. He got these properties, some fig deals dumped on him to do studies on. So he was able to approach the analysis of them, from an unbiased tax view and just look at them. So I've appreciated his perspective on that.
Yeah, it's actually had a client who purchased some fig properties and ended up doing some cost segs for. So I really didn't even know about fig before I started doing some research over the last few months. And, I think there's some great reasons to purchase from fig. These guys, fig, they're really doing their homework in the secondary and tertiary markets that are, having incredible growth. Just in, I think Utah County, just last year, I think the growth was 40%. And then when I went up to Meridian, Idaho, I was just amazed at how much development was going on. And I went to the planning commission and did a lot of research there. And those folks told me, even with all the building that's going on in that Boise area submarket, that there's still going to be 40,000 units short in their short-term plan over the next 5 years. So, from my analysis, it looks like Fig's really hitting the ball out of the park with their research, and they're building a brand new product. It's bulletproof, so you're not buying a lot of problems in it like you would maybe in an older property. And from the appreciation I've seen, it's been pretty incredible. So we could talk a little bit, transition over to, do you qualify as a real estate professional? Let's see here.
What does depreciation mean for, a W-2 employee? And then if you could just transition into what being a real estate professional does to enhance depreciation.
So, your rental income by definition is passive income, unless you are a real estate professional. So there's passive income and passive losses. Now, in order to become a real estate professional, I'm not going to kid you. You got to spend. It's not easy. You've got to spend more than half of your total personal services in real property trades or businesses. There's a 750-hour rule. There's a lot of different rules. And I'll tell you, for example, I had a client who was a doctor. He's W-2, making, over $250,000 a year. And he's got 3 rental properties, and, he wants to claim real estate professional status and claim he works 41 hours a week on them. And I'm like, that's bad fact pattern. You probably, if you get audited, you're going to get crushed. So, it's really a facts and circumstances issue, and you really have to be, if you're gonna attempt to be a real estate professional, find a CPA who's got a lot of clients who do it, somebody who's an expert. Don't try to do it without, proper guidance. But on the other hand, if you can do it, I've seen doctors who are married to real estate agents, by virtue of having a spouse as a real estate agent, they become, all their income now becomes active as well as their losses. So now you can, you've got to keep meticulous records with these hours and services. And you really have to have material participation in your rentals up to something like 500 hours. But, if you could document that, you've got a good case to become a professional, and the benefits are incredible. Now I realize, with spouses and, you really have to find out if it's really something it's going to work. So really, there's an action plan you can take to achieving it. I don't want to read all the bullet points, but, here are some of the points. Now, really, and the key one is, the takeaway is, really talk to your accountant about it, understand the requirements. And if you've got, we got somebody drawing in here. If you've got, seek out a good CPA if you really want to go down this path.
When I started looking at it myself, I asked my CPA at the time, how many clients do you have that are real estate professionals? He said, a few. And he wasn't my accountant for much longer, because like you say, there's a strict regimen that you have to adhere to. But explain briefly what it would do. Let's say you are a doctor and you've got a spouse that's a real estate agent, or maybe own 7 or 8 properties, and there's enough of a case to make there that, the spouse makes their living on real estate. What happens with depreciation there as opposed to somebody who can't be or isn't a real estate professional? Why would you want to do that?
Well, let's look at like one example, a case study. Say you have a doctor, they've got $250,000, all W-2. Their spouse is a real estate agent. So she is a real estate professional almost by definition. But you really I would go way above and beyond that, and make sure you document all the time spent in management of the properties. There are, and the benefit to it would be, let's say you had some properties and you had some rentals, and then let's say you did a cost segregation on one rental that created, let's say, $150,000 loss across the portfolio. And now with that $150,000 loss, you can use, since all the income is active, you can offset that $250,000 income with the $150,000. So you
normally you're going to depreciate over 27 and a half years. And just tell me if I have this right, if you would.
Yeah. Yes.
And once again, I can't say too much. Talk to your accountant on this, but so Bob, the real estate investor, has some rentals, but he's a full-time W-2 employee. So he can take depreciation over 27 and a half years, but if he makes too much money, he's kind of capped on the passive losses he can take, right? It's up to 25,000 a year, right? I think that's the figure.
Yeah, and then there's a phase out, and and it's really only between incomes of $100,000 to $150,000.
Yeah,
so it's such a narrow group.
You chew it up really quickly if you have any properties, and so it doesn't mean you don't get to use the depreciation. You could use that when you sell it to offset some gains. Tell me when I step in it here, if you would.
Yeah, no, you can actually carry forward those losses, and then and when you sell the property, then they can be realized.
Yeah. And so then with a cost segregation study, you're saying that, well, when was the last time you had carpet that lasts 27 and a half years, right? That there's lots of things that can and should be depreciated faster. So if you're a high income earner and you don't need carry forward losses, you need deductions now. That's where becoming a professional and then diving into cost seg is a big benefit. Do I have that right?
Yes, because for example, if you depreciate over 27 and a half years, typically, let's just say a basis of about, in the mid sixes, that's what it would be, after we take out the land. I would say, your increased first year depreciation with the cost segregation study is between $150,000 and $170,000. So if you have other rentals with passive income, like fully depreciated properties, or properties with very low loan balances, and you're throwing off a lot of cash flow, a lot of people will just buy these and then um, do the cost segregation study to get the first year bonus and use that as a bullet. They'll elect a grouping activity on all their rentals, and they'll use that as a bullet to eliminate, to shelter the other income.
Well, okay. So then let's go
Uh,
from achieving real estate professional to now we know by becoming a professional, our losses are now active and we can essentially have them be unlimited. So cost segregation crams forward as many losses into this first year as possible. So tell us about, now that we've covered real estate professional, what cost segregation is and what you do specifically there.
So with what we do with cost segregation is we do, and I can send you anybody who would like to take a look at one of my sample studies. It's about 100 pages long. It's fully engineered into the greatest amount of detail. So what we'll do is we'll take the obvious things that are 5-year property, like your flooring, if it's like a vinyl plank flooring, which is what they put in the big properties, the carpeting, any crown molding that might be there. But where we really get our yield is on the stuff that you can't see that's behind the walls, which would be called like branch electrical. So when you see one of our studies, you'll actually see like how many linear foot of branch electrical there is. So if you think about the big fourplex units, and you think about residential unit, all the electrical outlets that aren't that are beyond code, so you have to, whatever it is, every 8 feet. So all the other outlets that are in your kitchen, like the run appliances, that's all branch wiring. So anything that would run an appliance, a television, that's branch wiring, and that's 5-year items. So we get to that level of detail. And I think, Steve, we did a comparison on a cost seg study you had done, and the one I did, and we had an additional $40,000 of depreciation because we fully engineered our studies.
Yeah, that was crazy.
We actually took out more for land, which is, I think 5% is probably, if you had to explain that to an auditor, you might have some trouble, right? It's the old pigs get fed and hogs get slaughtered kind of. It's you don't have to really push it there because our studies are so well done that we're going to get the max.
Yeah. Well, I would imagine it makes a typical auditor's head spin if it's a study in that much detail. Like half of what you were just saying about behind the walls electrical, I didn't even know what that meant. So that's intense.
If you think about like a doctor's office, right? So I mean, you go into a doctor's office, they've got gas in the wall, they've got pneumatic gas, they've got laughing gas, they've got all kinds of gases in there, right? All kinds of tubes running in the walls in like hospitals and medical buildings. Specialty plumbing, think about a dentist's office. So it's all this stuff. So if you just thought about a building as a building, that all it needed was minimum fenestration, a roof, some lighting, and some minimal heating. Well, now you take a building, and we're going to take a building and we're going to make it used as an apartment building. So all that extra stuff that goes in there that makes it fancy. Like think about a casino. When you walk into a casino, everything's 5-year property in a casino. I mean, from the carpeting to the chandeliers to the, all of the sconces on the walls, the wall coverings. I mean, those are almost 60% yields. So typically, so cost segregation is the process of segregating a building into shorter lived assets. And we talked a little bit about the 5-year property. 15-year property would be land improvements like fencing, parking lot, asphalt, things of that nature. And so really, what is the benefit of a cost segregation study? Well, since the Tax Cuts and Jobs Act of 2017, it's bonus depreciation. You get 100% write-off of all of the 5 and 15-year property in year one if you do a cost segregation study, if you elect to do that. Now, the beautiful thing about the CARES Act in conjunction with that is now we can go back and carry back net operating losses 5 years at 100% of income. So the Tax Cuts and Jobs Act actually they slashed the ability to claim NOLs after 2017 to 80% of taxable income. So now you can go back and claim at 100% of taxable income. It also took away the ability to carry back those net operating losses back to prior tax years. But now you can go back 5 years, and you can go for tax years starting after December 31st, 2017. So that would be tax year 18, and before January 1st, 2021, that would be tax year 20. So from 2018, 2019, and 20, if you did a cost seg that where you incurred a loss in your portfolio, now you can go carry those back 5 years. And as folks were, I guess if we look coming out of the last Great Recession, folks were really started to make a lot of money in 17, 18, 19, 20, even 15, 16. So now you can go back 5 years and harvest those losses and basically claim tax refunds if you paid taxes. So that's really the beauty of the Tax Cuts and Jobs Act, bonus depreciation, and the CARES Act. You can really go back and catch up on this depreciation. And then even if you bought a building 2, 3, 4, 5 years ago, especially if you bought one out, since December 27th, 2017, you can still go back and cost seg it and get the 100% bonus. I've done cost segregations for people who have had buildings for 5, 10 years. They just, they can still, these and a lot bigger numbers, right, in the millions and millions of dollars basis, but they can still go back and catch up the depreciation. And the beauty is to do that, you don't have to amend a return. You file Form 3115, which is a change in accounting method form, and you attach it to the federal return. And it's not like that would trigger an audit. Now the NOLs, that's a different form you file, and your accountant can walk you through it, but I know it's Form 1045. So here's sort of what, depending on what property you have, what type, these are rough percentages on what we can reclassify and get 100% write-off on. So for an apartment building, it's about 30%, although I've seen them as high as 40%, especially when you get into a luxury property where it's got crown molding, wainscoting, chair rail, shoe molding, all especially if they're very fancily built out, because all of that is 5-year property.
So basically on a residential, like a fourplex, you can take 30% of it and cram it up into the first year for depreciation on average. Is that what you're saying here?
So roughly on, a $600,000 basis, we're getting close to 80,000.
Okay.
180,000, excuse me.
Got it.
And then, I don't know what people own in the audience. So this is just to give you an idea. Even a warehouse, if you bought a $2 million warehouse and you had to pay, let's say you took out 10% for land, so 1.8 million basis. I mean, 20% of that, still a pretty good number to write off immediately, $360,000.
Yeah.
So there's all kinds of cost segregation studies, right, Steve? We've taken a look. I've sent you the one I do. It's all spelled out in the audit techniques guide. The IRS actually prints that. It tells you exactly how to conduct a study. And these are the elements on the bullet points on the right is what they want to see.
Right out of the IRS guidelines. If you can provide this to them, you're pretty defensible. Is that what you're saying?
It's right out of their playbook.
Okay.
So, and anybody who wants to, I've got links to all that, and I've got some white papers on it. I'll be happy to send it to you with one of my sample studies. I mean, Steve, you had one study done, and it's like apples and oranges.
Yeah.
So let's look at a case study, the Brickyard. That's the one in Meridian, Idaho, that we just did.
Yep. This is one that we were going through the initial lease up on. A fair amount of people have completed fourplexes in here and have done cost segregation studies. And Mark, this is how we met, was over this property. So let's see what it really did. And keep in mind, this is somebody that is a real estate professional. So you've got to get there through a spouse or yourself owning enough properties and making a living in this. But it was pretty substantial tax savings. Go ahead, Mark.
Well, and I just wanted to share with, how I finally met Steve. I went out and did this cost seg study at the Brickyard, and I met, Kim is the manager out there, and she was just amazing. There was actually quite a bit of lease up activity while I was there. So I was very patient. I watched her closely, and she was very professional. with all of the folks. And I think she had about 4 or 5 move-ins that day, so it was pretty busy. And she went and showed me a couple of units because, according to the IRS, you have to do a site inspection and document it heavily with photographs. So, and she did a couple of property unit inspections while I was out there, and I was very impressed with her level of thoroughness. So, I mean, they've got a great team, these folks. So it was nice to see. So in this case study, the first year depreciation without cost seg would have been 11,000. We did a cost seg study. It produced $174,000 at first year depreciation. So over an additional $160,000. I think, Steve, the one we looked at that you had done was about $120,000. So, we're talking a 33% increase in write-offs, just because we're using a fully engineered study. And again, what I spoke to earlier is you can create NOLs with 5-year carrybacks with no income limitations. So the tax cut eliminated so we had the Tax Cuts and Jobs Act of 2017, and that limited the NOLs to 80% of income. And it also limited the ability to go back. So bonus depreciation, what is bonus depreciation? How did it come about? Because that term gets thrown around a lot. So I just wanted to sort of clarify to folks what it is. There has been some form of bonus depreciation around since 9/11. We all remember what happened on 9/11. And our government was, we were almost as paralyzed as we are today, although we're facing a little bit of a different enemy. And the government really wanted to stimulate construction spending, economic activity in that format. So that's when bonus came in. And bonus has changed. So, and it only used to apply to new construction, which makes sense because that's, construction is a great economic stimulator. But when Donald Trump, when they got this Tax Cuts and Jobs Act finally through, they said that right there, Section 2, provision expands the property eligible for immediate expensing to include used property, and that's huge. Now, you folks are buying all new construction, so it doesn't really matter, but now that used property, so you can go out and buy a 20-year-old building, do a cost seg, get your 30% reclassified, and still take 100% in bonus depreciation. And bonus depreciation applies to all property asset class lives of 20 years or less.
What if somebody's had a property for 10 years, they'd never done a cost seg study on it? Could they do one now and get bonus depreciation?
They probably not 100% and not on used property, but I mean, if they had self-constructed it, they could go back and maybe look at bonus. But if it's used property, they would just do a normal cost seg. But the beauty of it is, think about it. So if you have $1 million basis, okay, and let's just make it easy. 20% of that $200,000 was the 5-year property, okay. So you've been depreciating that 5-year property like 1/27th and a half, right? Because it's 27.5-year life every year. And let's say that would have been maybe, I don't know, something like $8 or $9 grand a year, right? Maybe 6. So in 5 years, you've depreciated $30,000, $6 grand. Well, if you did the study in year 6, you'd have an automatic catch up of that 30,000, 200,000 minus the 30,000, because it should have, it's 5-year property. It should have already been depreciated. So
I see.
Catch up. So that's actually a great thing too, the catch-up depreciation. So actually going back and looking, it's as long as you have enough basis, and we like to sort of put that at right around $500,000 in basis. Now with the bonus, you get typically $500,000.
Yeah.
But these FIG properties are perfect.
Okay. And whatever you're doing to get rid of those yellow lines, I say do more of that. That's good stuff.
I don't know who's erasing. Well, I'll tell you a funny story. So my brother-in-law, he's a little bit of he does some office hours, and he lives in Venice, and he's a little bit of a nerd. And so he had this, right when Zoom started doing this video conferencing, he had office hours, and he had a bunch of people jump on this call, and these kids I think he didn't secure it. And within like 5 minutes, these kids had come in and spray painted and graffitied his whole chat and very obnoxious things, but it's just amazing.
Well, if you're going to do that, it might as well be obnoxious. Yeah. Um, Before you go on to this slide,
Mhm.
um, and if you can't answer this question now, or if it's just too complicated to answer, then go ahead and punt and we'll deal with it later. But all this cost segregation stuff, is there any benefit now or later to somebody that is not a real estate professional to do that?
Yeah, especially like kind of what I talked about before. If you've got a portfolio of properties, and a lot of folks out there do, right? They've got properties throwing off cash flow, low mortgage balances. They've owned them for a while, so there's the depreciation shelter's gone. You can, and I see this happen a lot. People just go out and they buy another unit and use the bonus bullet to wipe out the income
I see. I
across
see.
across their portfolio.
Okay. Okay. That makes sense.
So that's just active for active. That's not doing anything fancy. That's all within your rental portfolio. I mean, sorry, passive for passive, passive income for passive loss. That's all within your portfolio.
Okay. Good to know. Good to know.
We're not even talking about being a real estate professional at that point.
Yeah. Yeah. All right. Continue, please.
And then, so again, I wanted to put this slide in twice because it basically shows you what the first year write-off can be, the percent, which is, and the reason golf courses are so high, just so you know, land improvements, that's what the golf course is considered a land improvement. So that's a 15-year property. So that's why it's so high.
So Fig, we're going to start doing a gig and the golf course investment group. We'll get on that quickly.
Well, you can still play in Arizona, right?
Yeah, I think they're going to open up a lot of that stuff. I watched the press conference. You might be able to play in a lot more places soon, but that's a whole nother thing.
Okay, so here, this 45L is the code section. It's a tax credit. It's been around since the Energy Policy Act of 2005. We all heard how Obama was the energy president, but we all know who was president in 2005. So it wasn't Obama. So that under the Energy Policy Act of 2005, a lot of people don't realize this, but there were, that's sort of when the solar credits started. All of these were extended under President Obama. Let's not kid ourselves. But just so you know the history, that was started in 2005. Now, 45L, it's been around, and then it lapsed, and then it been around, and they've always called it a tax extender package. So these credits, they expired a few years, they call it sunsetting. So the provision sunsetted a few years ago, and people sort of forgot about it. And with all the nonsense and bickering and, crazy stuff that's been going on in Washington, they've kind of, they've been talking about extending this for years now. And it finally at the end of 2019 got extended retroactively for 2 years and through 2020. Now, it's like, wow, you really gave us a lot of time to plan for this because it's a pretty lucrative benefit. Think about a typical apartment building developer who will build, 100, 200, 300 unit building, and then you multiply that by 2,000. I mean, that's a heck of a benefit, tax credit, and that's a dollar for dollar tax credit. It should, if you've got these things, and depending on how you hold the real estate, most people are in pass-through entities, so it'll hit your Schedule C, and then it should flow through the credit.
Imagine you're talking to an idiot. Just imagine. What is a dollar for dollar tax credit? So
for every dollar of income you have, you should be able to reduce your tax liability by that amount. So if you owe $5,000 in taxes and you have a $5,000 tax credit, it will reduce that tax burden dollar for dollar. Now that's different than a deduction.
It just wipes it out. Yeah.
Yeah. So a deduction just reduces your income, which is then subject to tax. So the tax credit reduces your tax burden.
What you owe. Oh, yeah.
Yeah.
So this is on this 45L tax credit situation. Riddle me this. If you're not a real estate professional, can you get it?
Yeah. So depending on how you're holding your real estate, I mean, you'd have to talk to your accountant, but most people hold their real estate in pass-through entities. So there's a Schedule K. So that credit goes right onto the Schedule K, and it should flow through to the K1s. It's something you need to talk to your accountant about. But there's a form to calculate it, and then the directions on the form say it should go
Yeah.
schedule.
So to tell me, and I maybe I'm getting ahead of myself, but I told everybody at the beginning this would be kind of like a conversation between us. I see over here we got a $2,000 credit, dollar for dollar per qualified unit. Somebody could not be a real estate professional, but if they bought a fourplex, could they reduce their tax bill by $8,000?
Yes. So through their so it would flow through their Schedule K, right?
Yeah.
So then you've got your your income. So whatever flows through your Schedule K onto your to your K1 will flow. That's what so that your income comes through there, right? So if you have a net operating loss, it would flow through that.
Yeah. Yeah.
You have a tax credit, it would flow through that, and then that would be available for you should be available to use against your income.
Okay. Good. That's great.
You have to, people's tax. I don't remember. I have a disclaimer. I'm not giving tax advice because everybody's, some people might have a 20-page tax return. Some people might have a 200-page tax return. So everybody's tax return is very different. And so the reason why this is so great for FIG owners is because the way that FIG doesn't, they're not going out and building 200 units and then selling them. The business model is to take deposits. So now the purchaser of the FIG units now becomes sort of what they call the eligible contractor, because you're taking the construction risk now. So whereas before, if it was an apartment developer who would just build 200 units and then would sell to the end user, that's not FIG's model. FIG's model is to get the investor in early, take the construction risk. So now that automatically entitles the FIG purchaser to the credits.
Oh, very cool. So because you're essentially hiring FIG's builder, you're the person that made it happen. You get the 45L. And I did see a question that is appropriate to answer now. You can definitely answer this. Someone's asking, do the FIG units qualify for this? Are they energy efficient enough?
Yes. So that's a great question. Thank you. So when I was in Meridian, Idaho, I went up there and I did, so the way, let me explain to you how we certify. We have to use an energy model, and that's a software-based system. It's got inputs. What we do is we model, so we're comparing it to a 2006 International Energy Conservation Code, the 2006 standard, right? We're in 2020. So FIG is actually building to a 2015 standard. It's on all of the building plans. So we say if you're building to a 2009 standard or higher, it's a pretty good chance you're going to pass. But we still have to run the model, and we put the inputs are a lot of it has to do with the building envelope, so that the insulation in the attic and walls, and FIG is doing a great job with that. Good windows, good foundations, great the way the coil on the HVAC and the outdoor condensing unit interface, it creates enough of an improvement. We modeled both Meridian, and we modeled the one in Spring, was it Bridgestone? Is that the name of it?
Yes, correct. Yeah.
So we actually pre-qualified both of those. So both of those qualified, and they were both over 50% improvement.
Okay, because I'm getting some questions in the chat asking about certain projects. You've specifically approved Bridgestone Crossing in Spring, Texas, and Village at Brickyard in Meridian for the 45L. And I would have a hard time thinking that our other projects, for example, in Utah, don't qualify. But that's something that clients can reach out to you to look into, include everything in that we've done in Utah and also upcoming in Arizona too.
Yeah, so Steve and I were talking, we've been chatting for the last a couple of weeks, putting this together. And obviously it took some time to qualify those two projects, but we were already talking about getting the plans and specs so we can get the other projects qualified. We didn't have enough time to get it all done before the presentation, but I feel confident, but we still have to run the model. And in effect, we're doing a lot of the work before we even start, right? Because we're never going to sell you something so imagine if you had a 100-unit building And I've done 100-unit buildings where maybe only 70 of the units qualified for some reason. So we're not going to go out and say, okay, we're going to do, and we charge by, the unit. So we're not going to go and say, okay, we're going to charge you for 100 units when you only got 70. No, you only pay for what passes. So we try to do all the work a lot of the work up front. So we're not wasting everybody's time.
So somebody sends you to evaluate a 45L, it doesn't pass, they're not paying.
No.
Okay.
No, and that's all in our memorandum, engagement, how we go about it. So,
okay.
And then what we do is we certify. We have to sign a statement under penalty of perjury, and then we can walk your CPA. There's one form that you have to fill out. It's one of the shortest IRS forms I've ever seen in my life. It only has like 4 boxes.
Okay. Well, let's continue on with this because it's getting everybody's a lot of interest. So let's proceed.
All right. So again, Energy Star is always good. It's called Section 45L. What we will do, at no charge, we'll examine the plans and the technical documentation. We do have to do a site visit, so we get enough people who want to do this. I can defray the costs on that. We will create models using the IRS approved software that we talked about earlier. We run full year simulations to test the design, installed systems. So a big reason for the site visit is because I've seen so many times on plans like, oh yeah, we're going to use this. We're going to use this, a certain sear, for example, on a condensing unit and a coil. Well, we get out there and we see they didn't put that in, right? They put some type of inferior product in. So thankfully to say that I've been very impressed with what FIG's doing and their building techniques and construction techniques, very high quality. And that's evidenced by, two whole communities passing. I mean, we basically certified 400 units already. So that's awesome.
Okay. Cool.
And then this is just, a little sort of a visual of what we're looking at. Insulation, of course, in the attic is very important. Sealed ducts. So sometimes, so we'll run the energy model. We've got to go out and do a site visit. Sometimes if the energy model it doesn't quite get over 50%, there's other inputs that we can put into it to try to raise it up. And we actually know the software behind the model. So we understand how this thing was written. So sometimes we'll have to come in and do duct testing and test for how tight they're sealed, and maybe like a blast test on a door to make sure it's sealed tight. So, we may have to do that, but, if we can go into 1 or 2 units in a 200 unit development and do that, that's enough because we'll just use sampling at that point. And those are some of the things, other tweaks we can do to get it to pass.
Okay.
So here's a case study at the Brickyard. So I had an owner who owned 8 units. We completed the certification. They received $16,000 in credits that are going to flow through their Schedule K under their K1. If we look at 215 units in the entire complex, that's a potential total of $430,000 in tax credits. So I mean that's just great stuff. The Bridgestone Crossing townhomes, we did the same. There's 200 units in there, and for every 4 units you get an $8,000 tax credit. It's a pretty nice deal.
Yeah, I'm going to have you do mine right away.
It's beautiful. So this is what the form looks like. I just had to put it on there. Remember, I'm not giving any tax advice, but a lot of people never.
That is the simplest form I've ever seen the IRS
so
produce.
It's like a real thing, right? It's not
a
thing. It's pretty nice.
Yeah.
And it's funny because there's actually manufactured homes. They have a deduction too, but it's $1,000. It's actually if they do meet a 50% standard, they can get $2,000 as well. So I do a lot of work for manufacturers and manufactured homes as well. It's a nice deal.
Very cool. Yeah.
And there's a lot of folks actually up in Boise who are, that's where a lot of modular homes are actually manufactured up there. Just as an FYI. So here's the CARES Act. The CARES Act, it's the Coronavirus Aid, Relief, and Economic Security Act. Um, we folks who've owned business, I'm sure there's folks out there, they've heard of this payroll protection loan. Those are good things up to, I think it's 500 employees. In fact, one of my buddies who makes modular homes up in Boise, he actually makes modular. He doesn't do the homes, but he does offices, and one of his biggest clients is the Department of Energy. He built like 120,000 square feet for them, but he's got a manufacturing facility, and he told me he just had $1 million show up in his checking account the other day. He was successful in getting a PPL, so that's
I've
good to hear.
almost got mine. Yeah.
Yeah, I know it's great because but so you really have to kind of, if you have a local community bank, somebody you have a banking relationship with, that's where I've seen a lot of success. I've also seen a lot of people that are just kind of hanging out waiting for it to happen. Right?
Yeah, you can't do that. That I've heard the same, that if you're going to go into Wells Fargo, good luck on your triple P loan. Go to a local bank, a local credit union. They've been much more effective at processing these. Do you know? So if you're a business owner, what if you own rental properties? Can you get a PPP loan? And so
if you've got employees in any
yeah,
business, right?
and if it's just you that's the employee,
if you've got a pay history, there's one employee there, you're supposed to get 2.5 times. If you've been paying yourself, like not as not taking draws, but actually put yourself on a salary, sure, why not?
Well, I have an S corporation. That's how I pay myself, because I'm technically self-employed. But with the S corp, there are various tax advantages, and I have a law firm that runs, or a law firm and accounting firm that runs payroll for me. I've got all the W-2s. I've got everything. So that's so far the bank has said, yep, you have what you need. Not to mention, everybody, that if you do that, your ability to qualify for mortgages is just exponentially easier because banks speak W-2.
Exactly.
Yeah.
They do. I've got a neighbor who's trying to sell his house, and the person they're not a W-2 employee, and it just fell out of escrow, but they're trying to bring like 50% down so they might qualify. But yeah, that's what we're seeing right now. If you own properties and people aren't paying their rent, so that was the big thing. Whoa, where are we heading? Is it going to be 60% of my tenants paying this month? Well, I think a lot of statistics have come out. I've talked to some of my friends who own some large projects, and they're saying they're at 92% collections. They were at 95. So that's still, I don't, the fallout, I don't think is going to really happen in April. We have to worry about May and June.
Yeah. And we've got a few, and I've seen, there's talk out there about how the money's already gone for that, but it's everybody I've spoken to, CPAs and such, it still apply because Trump's yelling at Pelosi about give us more money. She's saying, you give us more money. They're bickering about it, but it's been a very popular program, and most people in the know would be shocked if they don't eventually release more money for the triple P program. So it's worth it to apply, from everybody that I've talked to about that.
It is, and then, we have these recovery rebates, right? That's what, $1,200 that's going to everybody. But that's pretty low income. And then with the pandemic unemployment assistance, I think that's April 28th is when that's supposed to come out. So if you lost your job, I think at least in California, the maximum benefit's $450 a week, and they're going to slap on an extra $600 starting April 28th. And it might go retroactively.
The printing press is on. When they open up the bank tellers again, I'm going to take all the monopoly money out of my house and I'm going to go deposit it. It's going to be great. So tell me, Mark, the CARES Act, you had mentioned this briefly before, but with the Tax Cuts and Jobs Act from a few years ago that Trump put into place, it took away some of the tax benefits that investors had. And now with the CARES Act, you can reach back, and you talked about it a little bit. What does it mean to go back in time? And
that number two is the biggest right there.
Okay.
The 5-year carryback for net operating losses. And, you've got the cost seg with 100% bonus from the Tax Cuts and Jobs Act. So while the Tax Cuts and Jobs Act taketh away with the 5-year carryback, the CARES Act brought it back. and actually, I think it was only 2 years before. So now you have 5 years. No, and then you were limited to 80% of your income, and now it's 100%. So I mean, I know that. And then there was also an income limitation of what you could deduct, and I think it's a $500,000. So these are for really high earners. But that's those caps have been removed, I think, for 2 years now.
Oh, bottom line is if the Tax Cuts and Jobs Act restricted some losses, you may be able to go back and get those now, and you should talk to your CPA about that. Correct?
Yes, absolutely.
Excellent.
And then,
Yeah.
and then this is kind of like the stuff we don't want to talk about as property owners, but what, if we've seen, bills circulating, we're going to have 25% rent cuts across the board, government mandated. Well, I mean, these government folks, a lot, they don't even understand what that even means, because a lot of them haven't even lived in apartment buildings, right? You start doing that, well, people are going to stop cutting the grass. They're going to stop picking up the trash. I mean, it's a whole downward spiral, right? And then you're going to have to go to the bank and request a foreclosure moratorium. Well, nobody wants to do that. But those programs are out there, just so you know. A lot of banks don't like to talk about that, though, because I think we all understand the domino effect of that.
Do you know if the CARES Act mandated, was that what mandated mortgage forbearance and, the eviction moratoriums? I'm talking on the federal level, because every state has said different things about the ability to evict for the next couple of months. But did the CARES Act mandate banks to give forbearance? Because my understanding is that if you're a landlord, you're having a hard time making your mortgage because your tenants are late or they're not paying you, that really is between you and the bank. You need to call them and see what they have on forbearance. Do you have any knowledge or insight on that?
Well, if it's a federally backed loan, then you can request forbearance. So, like, for example, I have a buddy, he buys and he does the value add on apartment buildings, right? But he hasn't done a Fannie Mae loan in like 10 years because he's like a Chase preferred customer. And remember, these are 5 units and up. So I think that all 1 to 4 loans are federally backed.
That's what our preferred lender, Lane Aldrich at First Colony Mortgages, told me. That almost, and so if you own investment properties, everybody, that are not FIG, but that you did buy with a conventional mortgage, right? Maybe you got 20% down on a single family home in the Midwest or something, that is probably federally backed. And then almost all of the FIG long-term loans that have been done are federally backed. And so the servicer is who you have to call, and they basically have to give you something, but it's still chaos out there. You got to make sure, okay, are they going to just allow you to not make the payment for 3 months, but they're still going to report you to credit, or maybe at the end of the 3 months, they're going to say, great, now pay up all the 3 months retroactive, which doesn't do anything.
No,
so
they got to tack it onto the back.
Right. Okay.
See, now here's what you just mentioned, Steve. This is what, when you get on these other calls, right, with the real estate professionals, and we huddle up and like, what's going on? So we talk about, you mentioned the servicers. So the servicers are potentially the guys who could, go out of business, right? Because they're going to get stuck having to pay for 3 months, and then they're not going to have any cash coming in. So they still have to deal with it.
I was getting worked up about that the other day, because
that's another deal.
Yeah, I mean, it's if the tenant can't pay, the landlord can't pay, who's the investor on the back end that still is holding their hand out? It kind of feels like if we're all going to have to do it, we're all going to have to do it. But this I'm sure this will be argued about plenty in the coming months.
And in the unfortunate instant that you might have to do it, just make sure that you get some help from qualified professionals. You get your cash management and forecasting. When you come to the bank, right, come with a coherent plan, right, and they'll be a lot more receptive.
Got it. Sorry to interrupt. Continue, please.
They don't want to hear the dog ate my homework. They want to see the homework. So, and here we are. We got some contact information at the end, a disclaimer, nice little picture of me, and a little bio. And I thank everybody and let's take some questions. Let's open it
Yeah,
up.
let's do that. I'll unmute everybody shortly here. Mark, would you just make me the host if you don't mind, and you can fiddle around with that while I figure it out. But Mark's contact information is right there. You're all welcome to reach out to him. And I want to go through some of the questions that came in the chat, and then maybe we'd have time to take a couple just via the audio. So scrolling through here.
I can see some of these.
Oh, you see them too. Okay. Yeah. Why don't you just grab a few there that you feel like you didn't already answer?
Yeah. So does it mean that each fourplex will get 4 times 2,000? Yes, that's correct. Is 8908 available for single family homes? Yes, that's correct. So I work with a lot of home builders, national, local, regional. Think about it. Guys that are pumping out homes, they're doing 100, they're doing 200. We know the nationals, they're doing thousands. So yes, they can take care of it, take advantage of it as long as it's 3 stories or less above grade. Now California's got a little bit of a different interpretation. A lot of stuff in California is built on a podium because it's the density. So in California, we can actually go 3 stories above dwelling stories above the garage. So
okay.
The code's a little different. In California, of course, it's kooky. Let's see. There's a parking structure with the shade provided. Yeah, I mean, solar doesn't hurt. Do we have to hire a CPA and do a cost seg in order to get? So a cost seg is separate than the 45L tax credit. Most CPAs, they don't even know what, they don't do the cost segregation. They sub it out because in order to put somebody like me on the staff, it's a 6-figure, pay, and they don't do enough of them a year in-house to make it worthwhile.
If they turn in the cost seg report that you do over to their CPA, it's got what the CPA needs to do it, right? I mean,
absolutely.
Am I missing that? Okay.
All the depreciation schedules, we include those. We'll do the 481A adjustment. That's if there's catch up, not the condiment, but the catch up in the depreciation. And so we'll hold the CPA's hand if they're not knowledgeable about it. We'll help them.
Got it.
That's all part of that's all included in our fees. That's not extra.
Okay.
Cost, we're generally on a 20 to 30 to 40 to 1 return on the cost segs. Energy is a little different, but it's a credit also.
Okay. So the money you spend on it, you also get to write that off too.
Right. So, I mean, if you're paying, for every 1,000, it depends on your tax bracket, right? So if we use 40. So if you're writing it off, you just basically take 1 minus your tax bracket, and that's your actual cost. So if you're in a 40% tax bracket, 60% of the cost of the study is your actual cost.
Okay. And answer me this then. Investors in FIG are going to ask, well, what's the cost, right? I mean, you and I are working on a program where you've got 1 site visit done that's going to dramatically reduce. You get to do it at a better rate because you've already done the visit and all the units are the same. Is that correct?
Yes.
Okay. Well, and much of this depends on how many units a client has and where it is, but that's something that we'll be able to answer. And we're over here, like I said, working with Mark on getting the best possible rate for the FIG clients, given that there are some economies of scale available here. And so, okay. Continue with a couple of those if you want to elaborate on that.
Never going to on the energy, it's never going to exceed 20% of the credit. That's kind of market, sort of between 15 and 20% of the credit. When you add up everything that needs to go into it, the energy modeling, the travel for the site visit, everything. So, and then the cost seg, you're generally going to get, the return it's cost to benefit. It's pretty high. It's, your ROI is like between 30 and 40 to 1.
Yeah. If you spend a couple $1,000, you're probably going to reduce your tax bill by, and I'm just shooting in the dark, 50, 60 grand or something like that, potentially, depending if you're a real estate professional or not. And then some of the other things that go into there. So it's hard to answer that, but I've seen bills for cost seg studies as high as $5,000, but I know that you're nowhere near that. But everybody contact Mark with how many properties you got, where they're at, and he can give you a better idea for that. It's not just like a one size fits all. Depends on the type of the properties. Do you see any other questions that we have time for there? Because I want to get to one or two that didn't come through on the chat.
Okay, and then I see, what do storage units fall under? Yes, we can cost seg those. And just so you know, I'll do I won't charge any money to do a benefit analysis. So all I need to do a benefit analysis is like a closing statement, if it's already placed in service, a depreciation schedule. The closing statement will show me what was paid, and then I'll remove some. We'll decide how much to take out for land. If it's already on a depreciation schedule, then I see the placed in service date and the depreciable basis. So I'll put together what we call a benefit analysis, which will show you exactly what you're going to get, an estimate of it. But we're pretty close because we've done thousands of studies, so we pretty much know what we're going to get. Let's see. Steve, do you have?
Oh, sorry, I was muted. You got me now? Mark?
Yes, I can hear
you.
Can you hear me?
Okay, sorry. What I was asking is, a fair summary is, if somebody is considering this, you've got some documents that you'll have them send to you. You'll do a free benefit analysis and say, hey, X amount of dollars based on your properties, and here's the approximate savings I can get you on your depreciation and such. Fair summary? Yep.
And then I saw a question about the software only studies. Those are garbage. I compared Steve and I compared one. My yield was 33% better. And those studies are not defensible.
Okay. There you go. I've used those before, so I'm happy to know that.
I can't even imagine how you would like to talk to the auditor about the site visit.
Yeah. That's okay.
I mean, yours didn't even have any photographs.
Listen, it's painful. Let's not talk about it. Okay, we'll take a couple of questions. You'll have to jump right in. We're unmuting. Okay, Brett, are you unmuted?
All right, can you hear me?
There we go.
Oh, cool.
Yeah, so coming back on the energy efficiency tax, we've got 2 fourplex in the locks in Utah, but I thought one of you said that Utah properties, this would not work for them.
It does work. So the one I've qualified. I haven't qualified any of the Utah ones yet, but I'm confident that they will qualify.
Yeah, it's the same type of equipment and plans, and so Brett, what he's saying is that we'd be extremely surprised if it didn't qualify.
So to be able to go do that, Steve, do we work with you or Mark, or is someone going to pull together a number of investors that are in, say, the locks and be able to split the cost for that analysis?
Send Mark an email and copy your FIG team rep, and then we'll be able to coordinate. What I did is I had Mark go to my Texas units, I had the superintendent go take some pictures for me so Mark could do his initial benefit analysis. We could probably do something similar to that here. Like if you needed some pictures of units in Utah, Mark could at least get started and you'd know if it was worth pursuing. Is that right, Mark?
Absolutely.
Okay. Yeah. So just email, I think you would work with Chase over here, and just send him a message and copy Mark, and we'll get that information squared away for you, Brett.
Great. Thank you very much.
Yeah. You're welcome.
Oh, and I see the depreciation losses I see this question about recapture. I hear this all the time. Postponing the tax burden. It has to do with the time value of money. Would you rather have the dollar 10 years from now or the dollar today? I think we all kind of know the value. We all know the answer to that. I mean, because look, if you free up capital today, you can go out and buy another fourplex.
Yeah.
Right. Just keep leveraging.
Right.
So I mean, yes, there will be recapture, but who actually sells their property and takes and pays the taxes? everybody I deal with does a 1031 exchange.
Yeah, you keep 1031, or you know, that's, even though some of the benefits gone, you can go into an opportunity zone, which we do have one of those going right now in Provo,
really?
Utah. Yeah, we've got an OZ project.
Oh, that, congratulations. That's exciting. So that, then you can, the beauty of that is, so with opportunity, I do a lot of work with that as well. So
Oh, good.
opportunity zones, you basically are playing with house money till 2026 is when you have to pay the capital gain. And all you have to do is roll the gain. So you don't have to roll the whole basis. You get to keep the original basis and just roll the portion that's the gain into the new property. So I've seen people buy FIG units, 3 or 4 years ago, flip them with $150,000 gain. So now you could just take the gain portion, and you wouldn't have to roll the whole thing into a 1031, just the gain into an opportunity zone. You hold it for 10 years, bam, when you sell it, there is no capital gain. I mean, it's beautiful. You get to play with house money till 2026, so for another 6 years, and you hold it for 10 years, you step up the basis, zero capital gain.
Right. That's the only off ramp besides a 1031 exchange or dying, right? That I'm aware of anyway.
Yeah, everybody kicks the can down the road with the 1031, right? And then when you do die, you step the basis. Now with the current tax laws, the basis gets stepped up to market. So if you sold it upon death to the heirs, there would be no capital gain. There'd be no capital gain anyway. So,
yeah, it's almost like the IRS wants you to buy real estate.
tax code is really written for real estate professionals. It really is.
Yeah.
Look at what the president is. Everybody, thank you so much for having me. I really appreciate it. I know we're going through some tough times right now. Hopefully we can, you got to pay your taxes, but nobody says you got to leave a tip. So
there you go. Thank you, Mark, everybody. And thanks for your patience with some of the technical difficulties here. We did record this. We'll make sure we get it posted on the site so you can review. Mark's contact information is there, but if you don't have it for some reason or you need to reach back out to us, you know where to find us. Please stay safe. Let's all cross our fingers that we're talking about this virus situation in the rearview mirror at some point in the near future, and we wish you the best in the meantime.